Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Tuesday, everybody. I am still fighting off a mild flu, so my voice may still be a little bit funny today. Hopefully this is not too distracting. Of course, it is not a happy Tuesday for the victims of a landslide in southwestern China's Yunnan province yesterday. According to state media, rescuers have recovered the bodies of 8 people, and dozens more are believed to still be buried. The landslide hit the small mountain village of Liangshui in Yunnan province shortly before dawn, when most residents were asleep. A total of 18 homes were buried, and more than 500 people evacuated. To make matters worse, the temperatures in the region are dropping near or below freezing as the country faces a cold snap. 300 rescue workers have been deployed to the area. Now let's move through the main updates, which are all economy focused today. On Monday, the People's Bank of China kept its loan prime rates unchanged, despite concerns over a property sector downturn and weak investor sentiment. This has had many commentators and investors scratching their heads, one of which, interestingly, was Sean Rain, founder of the China Market Research Group, who is concerned about deflation. Rain has a reputation for being extremely bullish on China and taking a fairly pro-Beijing position on many topics over the years. So his statement in an interview yesterday to US-based CNBC's PBoC Europe is quite telling. This is what he said. Quote, "Deflation may soon start biting into Chinese growth. This is something investors need to be cautious of. The economy here is bad. It's really bad. I've been in China for 27 years, and this is probably the lowest confidence I've ever seen. So deflation is starting to wield its ugly head. Consumers are waiting for discounts. They're very nervous." End quote. He later added, quote, "I think you're going to deal with another 3 to 6 months minimum of very painful economy as China restructures, or as China, transforms its economy towards a more slower growth, fairer society." End quote. And again, this is coming from a usually very upbeat pro-Beijing voice. Now, why did the People's Bank of China keep its loan prime rates unchanged? Quote, "China's problem isn't that real interest rates are high. It is that demand is weak. Reducing the interest earnings of household savers along with the interest expenses of corporate and government borrowers actually worsens the income imbalance and drives the weak demand." End quote. Julian Evarts-Pritchard, head of China economics at Capital Economics, said policymakers, quote, "appear to harbour lingering concerns about the yuan," end quote, adding, quote, "a cut at this stage could trigger additional depreciation pressure, something the People's Bank of China wants to avoid. Therefore, it may stick to quantitative easing tools for now." End quote. Okay, we move on now with the main story for today, and once again, my apologies for my voice. I normally do not like to focus too much on the vicissitudes of the equity markets. Macroeconomic movements and trends are much more important. But the China stock market story from the last several months is so significant that we do need to follow it closely, as we have been in recent weeks. Last week we covered how Chinese stocks have had a dismal last few years, having lost more than $6.3 trillion in market value from a peak in February of 2021. Over the same period, US equities, for comparison's sake, fueled recently especially from a technology rally and Fed optimism, have gained some $5.3 trillion. Less than a month into the new year, as at the end of trading on Monday evening, a gauge of Chinese stocks listed in Hong Kong has already lost 13%, making it the worst performing major benchmark global index. As of the end of trading on Monday, the value of China's stock market has never been this far behind that of the US. As we can see, the market capitalization of the US stock market is now $38 trillion greater than that of Hong Kong and China put together. Michael Liang, Chief Investment Officer at Foundation Asset Management, Hong Kong Limited, expressed this week, quote, "China offers value, but catalysts are just not there. Meanwhile, the US market has momentum and economy on its side." End quote. US-based Bloomberg, which has been covering these developments closely, explains that investors have been underwhelmed by Beijing's efforts to revive an economy struggling with deflation and an ongoing property crisis. Their strategist Kumar Gautam added in a note this week that while China's correction may seem overdone, quote, "Our simulations suggest the pain can continue." End quote. Meanwhile, US-based Wall Street Journal reports on Monday that Chinese individual investors are piling into Japanese stocks as their own market flags, expressing, quote, "Money fleeing Chinese stocks needs to find a market that is big enough, especially if managers want to maintain their overall level of exposure outside the US. The $6 trillion Japanese stock market is a perfect new home." End quote. Japan's Nikkei 225 index has gained 9% already this year, just 6% off its record high in 1989. And these capital market movements are being felt everywhere. Singapore hedge fund Asia Genesis Asset Management, PTE, is closing its macro fund this week after suffering from a painful 18.8% loss in the first few weeks of January, hit by China's sustained stock market rout as well as Japan's rally. It bet that China stocks were cheap and shorted Japanese equities. In retrospect, of course, this was a terrible idea. The fund manager doesn't watch China Update, it seems. In a letter to clients, the chief investment officer said the fund had made a, quote, "big mistake," end quote, in trying to pick the bottom of the benchmark Hong Kong indexes, adding that he was, quote, "astonished," end quote, with the Nikkei Hang Seng spread. It has been such a dismal start to 2024 for the Chinese stock market that on Monday evening it was reported that Premier Li Qiang, at a meeting of the State Council, called for more effective measures to stabilize the stock market. At the meeting, Li emphasized the need to enhance the quality and investment value of listed companies, persuade more medium and long-term funds to invest in stocks, and strengthen the regulations that govern capital markets. Then, overnight, several international outlets, citing unnamed sources, reported on what the specific policies would be. UK-based Reuters, for example, reported, citing unnamed sources, that policymakers were seeking to mobilize about 2 trillion yuan, approximately $280 billion, mainly from offshore accounts of Chinese state-owned enterprises as part of a stabilization fund to buy shares onshore through the Hong Kong exchange link. US-based Bloomberg reported that officials, quote, "are also weighing other options and may announce some of them as soon as this week if approved by the top leadership," end quote, adding, quote, "the deliberations underscore the elevated sense of urgency among Chinese authorities to stem a sell-off that sent the benchmark CSI 300 index to a 5-year low this week, calming the nation's retail investors, many of whom have been bruised by the protracted property downturn, is also seen as key to maintaining social stability." End quote. Soon after this news, in trading Tuesday this morning, Hong Kong's Hang Seng Index surged over 3%, suggesting that the market, in the immediate term at least, likes what it is hearing. But it has taken a potential promise of trillions of yuan in stimulus. We will continue to follow this space closely. But just quickly, if you're enjoying today's video or getting some value from it, I have a huge favor to ask, and that is to like and subscribe. This is only 2 clicks of the mouse, but it is a huge help for me, and it's the best way, along with sharing the video, of course, to help the channel grow. And for those who want to help keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. The channel relies primarily on subscribers to keep going. Thank you so much, everybody, for the ongoing support. Let's continue. Next up, we note a few trends in trade which are being fueled by geopolitical and strategic factors. The first is that Russia has shot past Saudi Arabia to become the biggest source of Chinese oil imports in 2023, not only highlighting how Beijing is supporting their close partner in Moscow, but also the ineffectiveness of Western efforts to deprive Russia of oil funds to fight its war in Ukraine. China, the biggest global oil importer, purchased a record 107 million tons of crude from Russia in 2023, an over 20% jump year on year. Saudi Arabia saw 86 million tons of sales to the Middle Kingdom. According to Bloomberg calculations based on customs data, China's oil imports from Russia last year were worth $60.6 billion, which equates to an average price of about $77 a barrel. This is well above a $60 a barrel Western imposed price cap. The second trade trend which we take note of is that, unsurprisingly, China's imports of chip-making machines jumped in 2023, an obvious effort from Beijing winter-proofing itself from future US policies to retard China's semiconductor ambitions. According to official customs data published on Monday, imports of the machinery used to make computer chips rose 14% in 2023 to almost $40 billion, and this is despite an overall decrease in imports. US controls have been making it more difficult for Chinese firms to get access to technology to make the most powerful and advanced chips, a sector which Beijing believes is crucial to Chinese competitiveness in the coming next industrial revolution and catching up to the West. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. My apologies once again for my voice. Hopefully I should be on the mend in the next few days. Have a wonderful Tuesday, and I will see you all tomorrow.